Welcome to class 4 of our advanced accounting. In the previous class, we covered chapter 2 of your textbook, which is how to do consolidation at the date of acquisition. And in this chapter, we're going to talk about how to do consolidation subsequent to the date of acquisition. So first, let's do a brief review of the previous chapter. In the previous chapter, we talked about how to do consolidation at the date of acquisition. Specifically, we broke down the cases into two situations. The first situation is, for example, firm A obtain control over firm B. A survive, B dissolve. So this is the dissolution case. Under this situation, please take a minute. Try to think about what do we do on firm A's book? What do we do on firm B's book? What do we do on the consolidation worksheet? And what do we do going forward? Please pause your video for now. Okay, so in the dissolution situation, on firm A's book, we make a journal entry, which is debit firm B's asset at the fair value of those assets, credit firm B's liability at the fair value of those liability. And because A is giving out something to acquire B, so whatever A is giving, that is called consideration transferred. And we credit consideration transferred at the fair value of those consideration transferred. They can be cash, they can be in the form of stock, and so on and so forth. And then this journal entry can use a balance or unbalance. So if there's any imbalance, if the imbalance is at the debit side, we make it balance by debit goodwill. And if the imbalance is at the credit side, we make it balance by credit gain on bargain purchase. So this is the journal entry we make on firm A's book. And with regard to firm B, what we do is we close out firm B's book. So firm B dissolves, it no longer exists. So we need to close out his book. And then consolidation worksheet. So if it is in the dissolution situation, firm B dissolve permanently. And so which means that we already, by using this journal entry, we already moved all of firm B's assets and liability to firm A's book. So going forward, there's only one surviving firm. There's no need to do any consolidation. So there's no consolidation worksheet. And going forward, we don't need to do anything. There's no consolidation going forward. In other words, consolidation is only done one time at the date of acquisition through this journal entry. So this is the dissolution situation. And the other situation is the non-dissolution situation. So for example, firm A obtain control over firm B. Both A and B survive. And please take 1 minute, think about what we talked about last class. Specifically, what do we do on firm A's book? What do we do on firm B's book? What do we do on the consolidation worksheet? And what do we do going forward? Please pause your video for now. So if it is in the dissolution, if it is in the non-dissolution situation, meaning that both firms still survive as separate legal entity after the acquisition, on firm A's book, instead of moving firm B's assets and liability to its book, now because firm B still exists, so on firm A's book, we don't need to move firm B's assets and liability to its book. We simply will use an account, the investment account, to represent firm A's ownership in firm B. We debit investment, credit consideration transferred at its fair value. So this journal entry, this is debit investment, credit consideration transferred. This journal entry applies for both if the consideration transfers equal to the fair value of firm B's net fair value of its net asset, or if the consideration transferred is more than the fair value of firm B's net asset. But yeah, that's a third situation. If the consideration transferred is less than the fair value of firm B's net asset, we need to credit gain on bargain purchase through this journal entry. So this is what we do on firm A's book. And on firm B's book, we don't do anything. Firm B just operates as what it did before the acquisition. It doesn't need to make any journal entry at the date of acquisition. And then on the consolidation worksheet, so in the situation of both firms survive, consolidation is actually done on the consolidation worksheet. On the consolidation worksheet, we take from A's book at the end of the financial reporting period, and we take from B's book. We make some consolidation entries, and then we arrive at consolidated totals. And this is the number that we report to investors, or in other words, what investors see this last consolidated total number. Investors are not going to see from A's book. They're not going to see from B's book. What they are seeing are the consolidated total numbers. So, and there's one thing to pay attention here. On the date of acquisition. So firm B's income statements are only consolidated for the amount after acquisition. Or in other words, if it is on the date of acquisition, basically we don't consolidate any of firm B's income statement. Think about why. So why do we not consolidate any of firm B's income statement on the date of acquisition? Because firm B hasn't earned any income yet. So this is just day one of the acquisition. It hasn't earned anything yet. So we don't consolidate firm B's income statement on the date of acquisition. But we do need to consolidate part of firm B's income statement after the date of acquisition. And we're going to talk more about it in today's class. And what do we do going forward? So going forward, both firm A and firm B keep its own book, and consolidation is done periodically on the consolidation worksheet. Or in other words, firm A still keep its own book, firm B also keep its own book, and at the end of every financial reporting period going forward, we need to make this consolidation worksheet again and again, and then we take the last column for each period to report it to investors. So this is just a repeat of what we talked about last class. And let's do a review example just to test whether you still remember what we learned from last class. On January 1st, parent exchanged 15,000 shares of its common stock for all of the outstanding share of the subsidiary. Each of the parent's shares has $4 par value, $50 fair value. Parent also paid $25,000 in stock registration and insurance costs in connection with the merger. And then please complete the handout. So if you go on Island, you're going to see an empty handout. And then I have also posted the solution, but before, just try to work on this example before looking at the solution, just to see how much you can work it out. So I'm going to give you 5 minutes. Please pause your video for now. So this handout has 2 pages. The first page is the situation that sorry. Is the situation that the subsidiary dissolved. So in other words, the subsidiary no longer exists after the acquisition. And the second page is the situation the subsidiary does not dissolve. So let's look at the first situation first. In the situation that subsidiary dissolve, what we do is basically we close out the subsidiary's book, and then we move all of subsidiary's assets and liability at their fair value to the parent's firm's book. So let's first look at this journal entry, stock issuance fee. As we mentioned at the end of last class, this is one of the 3 kinds of additional costs that may associate with the merger. And in the situation that firm issues stock, to do the acquisition, there may be some stock issuance fee associated. And this journal entry is separate from the journal entry we talked about regarding the merger. So this is a separate journal entry. Specifically, the firm paid 25,000 registration fee so that cash decrease by 25,000. And then it is recorded as a decrease in additional paid-in capital. So additional paid-in capital, the balance is at the credit side. In order to decrease it, we debit additional paid-in capital, 25,000. And then the parent's journal entry. So parents basically move all of subsidiaries' assets and liability at their fair value to its own book. Specifically, the subsidiary has cash, 29,000. Receivables, 63,000. Trademark, the fair value is 225,000. Record music category, the fair value is 180,000. In-process R&D, so this is interesting, right? Without the merger, those kind of intangibles, they are not valued on the firm's balance sheet. But through this merger, they get to be valued, revalued at their fair value. Specifically, the fair value of in-process R&D is 200,000. So we debit 200,000 in-process R&D. Equipment, 105,000. And then account payable, the fair value is 34,000. Notes payable, fair value 45,000. And then those are all of the subsidiaries' assets and liability. And if you still remember from last class, depending on there's another question here. So depending on whether there's any goodwill in the merger, we may or may not need to record the goodwill, but we're going to look at it later. So, and then let's look at what does the parent give to acquire the subsidiary. So that is the consideration transferred. The parent basically, it issued 15,000 stocks in order to acquire the subsidiary. So the par value of those 15,000 stocks are 4 per stock. So that goes to 60,000. So common stock increased by 60,000. And additional paid-in capital, that's 15,000 number of stocks, multiplied by $50, the fair value minus 4, the par value. So that is 690,000. Additional paid-in capital goes up by 690,000. And then this journal entry, it is not going to balance. The imbalance is actually at the debit side. So which means the firm is paying more. The parent is paying more to acquire. The parent is paying more than the fair value of the subsidiary's net identifiable asset to acquire the subsidiary. So the difference is called goodwill, which is 27,000. And now this journal entry shows balance. So the last column, the parent's book post-merger, it's basically we need to take parent's book before the merger. And then this is one journal entry the parent is making to record the stock issuance fee. This is another journal entry the parent is making to record the acquisition of the subsidiary. And then the parent's book post-merger is basically 1 + 2 + 3. So those 3 columns will take the parent's book before the merger plus the 2 journal entries the parent made during the merger on the date of acquisition. So, and that will give you to total cash of 60. Total cash of 64,000. Receivables adds up to 113,000. Trademark 625,000. Recorded music category, that's 1,020,000. In-process R&D 200,000. Equipment 425,000. Goodwill is 27,000. And then if you add them all up, you will get total asset, which is 2,574,000. So one thing I kind of want to mention a bit is, if you look at this goodwill, in chapter 1, we talked about the equity method. And in the equity method, if you look at all of the journal entries we make, have we ever recorded any goodwill in the equity method? So, which is if the ownership is between 20 to 50%. Actually, no. So under the equity method, if a firm has only been using equity method investment, you should never see a goodwill account on the firm's book. So it never recorded goodwill, even though there's something we identify as goodwill, but it's never get to be recorded on the firm's book. Versus here, if in the situation of a consolidation, the firm has more than 50% ownership of the subsidiary, then in this situation, we do record goodwill. So this is the only situation you are going to see goodwill on the firm's book. So yeah, this is regarding goodwill account. And then let's look at liability and shareholders' equity. The total accounts payable adds up to 144,000. Notes payable adds up to 415,000. Common stock adds up to 460,000. Additional paid-in capital 695,000. Retained earnings is 860,000. So and then if you add them all up, your liabilities and shareholders' equities should add up to 2,574,000. So your total asset and total liability should equal. This is just a check for you. They should equal. If they don't equal, there's something wrong. So that is the first situation when dissolution takes place. And now let's look at the second situation when there's no dissolution, subsidiaries does not dissolve. And in this situation, so the stock issuance fee, this journal entry is the same as before, like it's independent of what we record for the acquisition. So this is just a separate journal entry. We credit cash 25,000, debit additional paid-in capital 25,000, and then the parent's journal entry. So the parent's journal entry, as I just mentioned, in the situation of subsidiary does not dissolve, the parent is basically use the investment account instead of just putting all of subsidiaries' assets and liabilities. So it is recording everything into the investment account. Specifically, the parent is giving out common stock, 60,000, and then 60,000 in par value and 690,000 in additional paid-in capital. And correspondingly, this consideration transfer is recorded as an increase in the firm's investment account, 750,000. So, and then the parent is going to make this journal entry first. And then at the end of the financial reporting period, the parent is going to take his book, take the subsidiary's book, and do 2 consolidation entries. So specifically, the consolidation entries at the date of acquisitions are consolidation entry S and consolidation entry A. Consolidation entry S, the purpose is just to eliminate subsidiaries' shareholders' equity account. So subsidiaries shareholders' equities, we have common stock, additional paid-in capital, and retained earning. And to eliminate those accounts, we debit 50,000 common stock, debit 30,000 additional paid-in capital, and debit 190,000 retained earning. And correspondingly, so 50 plus 30 plus 190,000, that adds up to 270,000. So correspondingly, we decrease the investment account by 270,000. So this is consolidation entry S. Consolidation entry A, the purpose is to increase the subsidiary's assets and liability from its book value to its fair value and to recognize any goodwill if there's any. So the difference between subsidiary's book and fair value, we say that subsidiary has a difference in Receivables, the difference between fair and book values are negative 2,000. Trademark, the difference is positive 130,000. Record music catalog, the difference is 120,000. In-process R&D, the difference is 200,000. And then we have, the firm has a goodwill, so we need to recognize it as well in consolidation entry A, which is 27,000. Notes payable, the difference is 50,000. It is 5,000. So, and then after marked up the subsidiaries book value to fair value, now what do we need to do? We need to decrease the parent's investment account accordingly. So if you add all of those up, that adds up to 480,000. And that decreases your investment account by 480. And then the last column, consolidated total numbers. Basically, we take the parent's book, and then we add this journal entry, stock to record stock issuance fee. And then parent's journal entry, consolidation entry S and A. So it's 1, 2, 3, 4, 5. We add up those columns. Cash, after you add them up, it goes to we need to add another column, which is 6, subsidiaries book value. Sorry, I forgot this column. So we need to add, so we take the parent book and then we take the subsidiaries book. We take all of those consolidation entries. So the cash adds up to 64,000. Receivables is 213,000. Investment should go to 0. Trademark is 625,000. In-process R&D 1,020,000. Equipment is 200,000. Oh, sorry, in-process R&D is 200,000. Equipment is 425,000. And goodwill is 27,000. So, and then we add them all up. You will get total asset of 2,574,000. The liability and shareholders' equity side, our account payable will add up to 144,000. Notes payable, 415,000. Common stock, 460,000. And additional paid-in capital, 695,000. Retained earning, 860,000. If you add them all up, that will add up to 2,574,000, which should be equal to your total asset. So here, so after you finish those two worksheets, there are 2 places I want you to think about. We kind of talked about it in last class, but I just want to illustrate it again through this example. So the first place is your investment account should go to 0. So no matter in which situation, in the first situation, we don't record any investment. We don't record anything into the investment account. It is 0. In the second situation, it should go to 0. So if it's not 0, there's something wrong. So this is something you should check. And another place is, if you compare the last column of the second situation and the last column of the first situation, you are going to see exactly identical numbers here. So which is just no matter which method you are using, like after consolidation, what investors seeing will be the same, no matter whether there's dissolution or no dissolution. So regarding the first point, the investment account going to 0, please take 1 minute, think about why your investment account will go to zero. We talked about it, but I still, like through this example, I want you to think about, take 5 minutes, think about why in the second situation, we ended up having a zero investment account after consolidation. Please pause your video for now. So why do we have a zero investment account in this situation? If you think of the definition of a goodwill, what is goodwill? Goodwill is your consideration transferred if it is more than the fair value of your net asset, then the difference is called goodwill. That is the definition of goodwill. So in this situation, this is a goodwill situation. The initial amount we record in the investment account, this is the consideration transferred, right? So for the investment account, the initial journal entry made on from A's book, made on the parent's book, that we record the whole consideration transferred into the investment account. And then what do we do in the consolidation entry S? So in consolidation entry S, we eliminate the subsidiaries shareholders equity account. Basically, we eliminate in the correspondingly, we decrease the investment account. So the amount we decrease in the investment account should exactly be equal to the book value of subsidiaries net asset, right? So that is the book value of subsidiaries shareholders equity. So we minus the book value of subsidiaries net asset. And what do we do here? What is this 480,000? So consolidation entry A, we use it to mark up subsidiaries book value to fair value and to recognize any goodwill. So this 480, it will include the difference between fair and book value of the subsidiaries net asset plus the goodwill. So what is your result? If you add all of those up, what are you going to get? Book value will cancel out and you are getting consideration transferred minus the fair value of subsidiaries net asset minus goodwill. So what is it? Goodwill equals to consideration transfer minus the fair value of the subsidiaries net asset, which is consideration transferred minus fair value minus goodwill should be equal to zero. So that's why this is something you should always check after you have done you have finished the consolidation. Your investment account should go to zero. So this is the first point. And the second point is, so no matter whether it is in the dissolution situation or non-dissolution situation, your last column, your consolidated total numbers should always be the same. And please also take 5 minutes, just look at this example and try to figure out why in these two situations we're getting the same last column. Please pause your video for now. So why are we getting the same last column in these two situations? We talked about not kind of theoretically in last class why your last columns should be equal in these two situations. But let's just use this example as to give you a more concrete idea what's happening here. So in the first situation, when subsidiary dissolve, we have the parents is making this journal entry, right, to move all of subsidiaries' assets and liability to its own book. So this is, if we may call it the journal entry 1-3. So when dissolve, we have the journal entry 1-3. And then it's basically, if you look at what we are doing here in the second situation, when subsidiary does not dissolve, no dissolution, we have the subsidiaries book. So we may call it journal entry 2-6. And then the parent is making a journal entry. So journal entry 2-6 is just represent the subs book value. And then the parent is making a journal entry. Journal entry, we may call it 2-3. So the journal entry 2-3 is basically recording the consideration transferred. And then we have 2-4, which is the consolidation entry S. 2-4 to eliminate the book subsidiaries shareholders equity account. And then 2-5 is to mark up the book value to fair value and to recognize any goodwill. So if you look at those journal entries, basically what we do in 1-3, it is broken down into 1, 2, 3, 4, 4 journal entries in the second situation. So we're breaking down in 1-3, we are recording subsidiaries fair value, and we are also recording goodwill if there's any. And in 2-6, we're recording subsidiaries book value. 2-3, consideration transferred. 2-4 doesn't really, it's just to eliminate the redundant part, which is the subsidiaries shareholders equity account. And 2-5, recognize the difference between fair value and book value and to record any goodwill. So basically 1-3 is broken down into the other 4 journal entries. That's why those 2 methods achieve the same ending result. They should always achieve the same ending result. So this is just a brief review of what we learned last class. And then after 1 minute, we're going to start talk about, so this is what we do, the consolidation at the date of acquisition. And then we're going to talk about what do we do subsequent to the date of acquisition.